Well, all I can say is it pays to be a contrarian. About 3 months ago, no one wanted to own a group of stocks that are called consumer staples. These are companies that have a great deal of dividends. They generate a lot of cash with their businesses, and they sell everything from soup to soap. In fact, investors were selling these stocks pretty much hand over fist in the first 5 months of the year. Most were down by double-digit percentages. And as I noted in an article on May 8th, investors had a great many excuses for selling these. Wall Street was telling us that they're too boring, they're growing too slowly. I saw one, it was my all-time favorite excuse, which was that there's this new paradigm somehow out there, as if people aren't going to buy detergent or food anymore. It's kind of crazy when you think about it. And buying over-owned, in some cases very overvalued tech stocks, I'm sure seemed a lot more exciting. But to me, it all sounded like a fantastic buying opportunity. That's why I said back on May 8th to buy the Consumer Staples Select Sector SPDR ETF. The symbol is XLP. And now that same ETF is up 12% in just 3 months. Now, how did I know about all this? One way was by monitoring dividend yields. Most consumer staples companies pay a dividend. And of course, the cheaper the stock gets, the lower it goes in price, the higher the dividend payout is as a percentage of that stock price. And by last May, the dividends for the yields for these consumer staple stocks were getting quite large. You could see that in the dividend paid by the Consumer Staples ETF. As I noted in my original article back in May, anytime you bought this ETF when its dividend yield hit 2.75% or better in the last decade, you were rewarded in the following months with stock gains of between 9% and as much as 28%. And so, of course, it's worked out that way yet again. The ETF's dividend yield topped out at nearly 3% before investors rediscovered the sector 3 months ago and began to bid the stock higher. Now, right now, the ETF is paying an annualized dividend of about $1.58 a share. By that measure, the price of the ETF would have to hit $68 or $69 a share for the dividend to hit an equivalent yield of 2.25%. Now, that's a pretty big leap from current prices. It might seem extreme, but I believe the consumer staples sector is in many ways ideally positioned. If the broader market heads to new record highs here, then the sector will continue to benefit from investors who like being defensive minded, who like being in these safer type stocks. Likely as well, if the market weakens and heads lower, then the consumer staples companies will also benefit as yet more investors pile into these defensive minded stocks seeking safety from the storm. Remember to keep liking us on YouTube, on Facebook, and on banyanhill.com. I'm Jeff Yastine for Total Wealth Insider.